Hard to believe, but we are in August already. The good news is stocks are still firmly in a bull market. But the bad news is the calendar is a potential worry now. More on that and how it could affect the markets on this week's edition of the Fastest 4 Minutes in Finance. Welcome in. I'm John Shrewsbury. Scott Inman is away on vacation this week. As you see in the LPL chart of the day, August and September have been historically two of the weakest months of the year. In fact, during a post-election year, August has been quite historically volatile, and only February is worse on average. Turning to September, it has indeed been historically the worst month of the year on average. Don't forget that last year stocks saw a 10% correction during this troublesome month. Taking a step further, stocks tend to peak early in August when a new party is in power in the White House. August 6th is the day stocks peak, and they don't bottom until September 25th, that on a historical basis. Meanwhile, during a post-election year, stocks peak on August 3rd and bottom on September 24th. Again, showing how the next several weeks can potentially be dangerous. Another headwind that might hurt stock prices in the near term: inflation. Consumer prices increased for the fourth straight month in June. The headline Consumer Price Index, or CPI, annual rise was the largest increase in 13 years. Prices for used vehicles, hotels, and restaurant meals were the largest drivers in June. Moreover, one major reason for the increase was the continued base effect due to depressed economic conditions last year from COVID-19. Removing volatile food and energy prices, the June core inflation index increased 4.5% from June of 2020, the largest increase since September of 1991. Producer prices in June increased the fastest rate in more than 10 years, year over year. The June PPI increased over 7%, while its month-over-month increase was 1%. Now, it isn't all bad news, though. With the economy rebounding and earnings soaring, we should see any seasonal weakness in the market, and we'd like to use that as an opportunity to add to core equity positions. Ryan Dietrich with LPL Financial says the S&P 500 is up an incredible 6 months in a row. And so Dietrich goes on to say that what we're really dealing with here might be just a very bullish event with a pause for an opportunity to invest. 1 year later, the market has been up 18 of 21 times, since with nearly a 12% average return in times like these. The bull might have a few tricks still up his sleeve. And that's the Fastest 4 Minutes in Finance. I'm John Shrewsbury.